Congratulations, you just bought a house to rent out on Airbnb. You're all ready to go, you've got guests lined up, you got the income, but have you thought about the taxes? How is it different if you have a mortgage? The IRS taxes rental income just like ordinary income, but there are a ton of ways to bring that number down. In this video, we're going to break down exactly how the IRS looks at your rental income, and we'll give you a roadmap to keep more of that money in your pocket. The IRS taxes your rental income the same way as your regular job income, whether you have a mortgage or not. The difference is how you report it. Instead of a W-2, you report rental income on Schedule E Form 1040. Your tax rate is based on your normal income tax bracket. Keep in mind that rental income isn't just rent payments. It also includes things like non-refundable security deposits, pet fees, cleaning fees, and cancellation fees. If you expect to earn more than $1,000 from rentals, you need to make estimated tax payments every quarter or by increasing your W-2 paycheck withholding to account for the income you expect to earn. Short-term rental income can be very tricky to predict because rates and occupancy change often, and you may not have the data from past years. There are two ways to do this, manually or by using a vacation rental calculator. Let's look at both options. Manual calculation. A simple equation you can use is to multiply the annual occupancy rate by the average daily rate and then multiply that number by 365 days. Or you can adjust the number of days if your property is not available year-round. For example, in Jackson Hole with a 36% occupancy rate and $409.50 ADR, it comes out to $53,808.30 per year. Number 2, vacation rental calculator. An Airbnb calculator can give extremely accurate estimates by analyzing nearby properties, creating an index based on relevance, integrating critical market metrics like seasonality and occupancy, comparing your property to similar listings. This tool will then project the total rental income based on the performance of similar properties, which you can use to calculate your rental income tax for any given year. Deductions can lower the total amount that you owe in taxes. Most people take a standard deduction, which is a set amount of money that the IRS lets you subtract instead of adding all your individual deductions. But itemizing your deductions can cut back on your taxes even further. The 9 most common deductions that hosts make are mortgage interest payments. Your mortgage itself isn't a deductible expense, but the mortgage interest payments are property taxes. You can deduct any property taxes associated with your rental property. Operating costs. This includes property management fees, costs for maintenance and repairs, and utilities. Travel. If you own multiple STRs and you need to travel to them as part of your rental property business, you can deduct the expense of those trips. Home office expenses. Some short-term rental hosts are hands-off, but if you're managing your rental business from a dedicated location inside your home, you can deduct a portion of your utilities and home insurance. Professional fees. Many hosts work with lawyers, accountants, or property managers. The fees you pay for these types of services are usually deductible expenses. Advertising. If you pay to market your STR or list it on a site, those fees are also deductible expenses. Insurance. You can deduct the insurance premiums you pay for your rental coverage. Depreciation. As your property loses value due to wear and tear, you can deduct a fixed percentage of your taxable income to help with improvements. A very important thing to consider is that you must make sure the IRS considers your home a rental property in order to qualify for these benefits. Many people buy rental homes because they also want to stay there sometimes. That is perfectly fine, but how often you use it for yourself affects how the IRS taxes it. Rental versus personal residence. If you use the property yourself more than 14 days a year, or more than 10% of the days that it's rented, the IRS calls it a mixed use. Mixed-use properties are still okay, but you must separate your personal expenses from the rental expenses when filing your taxes. Only rental expenses can be deducted. Losses. If your rental expenses are higher than your rental income, then you have a net loss. Rental properties can deduct that loss, usually only against other rental income. Personal residences can't deduct your rental losses against your regular job income. Home office deduction. If you rent out a dedicated space in your home, like a one-room suite, you may qualify for a home office deduction since it counts as a business use. There are several considerations when you sell your short-term rental. It isn't just as simple as walking away with a good profit. How much you owe depends on many factors, like how long you've owned the property and whether it's classified as a rental or as a personal residence. Here are some of the taxes to consider. Capital gains tax. This is a tax on the profit that you made. It's usually the sale price minus what you paid plus any improvements minus depreciation. If you've owned a property for less than 1 year, it's considered a short-term capital gain and you'll pay your normal tax rate. But if you've owned it for over a year, it will be considered a long-term capital gain and your tax rate would typically be lower. If you claim depreciation on your property, you may have to pay some of it back when you sell. This recapture is the amount of depreciation deductions you claimed or you could have claimed, usually taxed at 25%. Net investment income tax. This is a tax that typically applies to high-income earners. If this applies to you, you may pay an extra 3.8% on your gains. 1031 exchange. Also called a tax-deferred exchange, this is a strategy to delay paying these taxes by reinvesting the sale money into another property, following IRS rules. Primary residence exclusion. If the rental property was also your main home for at least 2 of the last 5 years, you may not have to pay capital gains tax at all. Owning a rental property can be an amazing way to build wealth, but taxes are part of the game. From deductions while you own it to capital gains when you sell, knowing the rules helps you keep more money in your pocket and avoid surprises. Remember, it's not about paying the minimum possible amount of taxes. It's about maximizing your deductions while staying compliant with the IRS to avoid any future problems. So grab that calculator or a good tax professional and play it smart, and let your rental work for you, not for the IRS. If you found this video helpful, give us a thumbs up and subscribe for more taxes and income recommendations for your Airbnb. We also have tons of different videos on our YouTube channel that you can check out. If you have any questions or tips, be sure to leave a comment below. We love hearing from you. Happy hosting and see you next time.